Risk management is a crucial aspect of Forex trading that helps traders protect their capital and minimize losses. Without a solid risk management strategy, even the best trading plans can fail due to unexpected market movements. Successful traders understand that preserving their capital is just as important as making profits. In this guide, we will explore 10 essential risk management techniques that can help Forex traders manage their exposure and improve their long-term success in the market. 1. Setting stop-loss orders. A stop-loss order is a predetermined price level at which a trade is automatically closed to limit losses. This tool helps traders protect their accounts from significant drawdowns. Placing stop-loss orders based on technical analysis, such as support and resistance levels, improves effectiveness. Traders should avoid setting stop losses too close to entry points to prevent premature exits. A well-placed stop loss ensures that emotions do not interfere with decision-making. Adjusting stop loss levels based on market conditions is essential. Using a trailing stop loss can help lock in profits while limiting risks. Every trade should have a stop loss in place before execution. 2. Using take-profit orders. A take-profit order is a predefined price level where a trade is closed to secure profits. This strategy ensures that traders do not hold onto winning trades for too long and risk losing gains. Take-profit levels should be set based on risk-reward ratios and technical indicators. Traders must avoid greed by taking profits at reasonable levels rather than expecting unlimited gains. Combining take-profit orders with stop-loss orders creates a structured risk management approach. Price action and trend analysis can help determine ideal exit points. A disciplined take-profit strategy leads to consistent profitability over time. Traders should regularly review and adjust their take-profit targets. 3. Risk-reward ratio strategy. The risk-reward ratio compares potential profit to potential loss in a trade. A common rule is to maintain a minimum risk-reward ratio of 1 to 2, meaning potential profit is twice the potential loss. This approach ensures that even if some trades fail, overall profitability remains intact. Traders should avoid taking trades with an unfavorable risk-reward ratio. Analyzing historical price data can help determine optimal risk-reward settings. Combining this strategy with technical analysis improves trade quality. Higher risk-reward ratios increase long-term success rates. Consistently following a favorable risk-reward ratio prevents emotional decision-making. 4. Position sizing techniques. Position sizing determines how much capital to risk per trade. Traders should never risk more than 1–2% of their total account balance on a single trade. Proper position sizing prevents large losses that could wipe out a trading account. Using a position size calculator ensures accurate trade allocation. The lot size should be adjusted based on market volatility and stop-loss distance. Risking a small percentage per trade allows traders to withstand losing streaks. Dynamic position sizing adapts to market conditions for optimal risk management. A well-structured position sizing plan leads to long-term trading success. 5. Leverage control and margin management. Leverage allows traders to control larger positions with a smaller capital investment. While leverage can amplify profits, it also increases risk exposure. Traders should use leverage cautiously and avoid excessive margin usage. Keeping leverage levels low helps prevent rapid account depletion. Understanding margin requirements helps traders avoid margin calls. A disciplined approach to leverage ensures account sustainability. Monitoring margin levels regularly prevents overexposure. Risk-conscious traders use leverage responsibly to balance risk and reward effectively. 6. Diversification in Forex trading. Diversification involves trading multiple currency pairs instead of focusing on a single pair. This reduces dependency on one market movement and spreads risk across different assets. Traders should select currency pairs with low correlation to avoid excessive exposure to similar market trends. Diversifying across different trading strategies further enhances risk management. Proper research is required before adding new pairs to a trading portfolio. Diversification does not eliminate risk but helps mitigate potential losses. A balanced portfolio improves consistency in trading results. Traders should periodically review and adjust their diversification strategy. 7. Managing emotional trading risks. Emotions such as fear and greed often lead to poor trading decisions. Overtrading, revenge trading, and hesitating to enter or exit trades are common emotional pitfalls. Traders should develop a disciplined trading plan and stick to it regardless of emotions. Using automated trading tools can help reduce emotional interference. Taking breaks after a series of losses prevents impulsive decision-making. Keeping a trading journal helps identify emotional patterns and areas for improvement. Psychological discipline is essential for consistent performance. A stable mindset enhances long-term trading success. 8. Implementing a trading plan. A trading plan outlines entry and exit strategies, risk management rules, and trading goals. Having a clear plan reduces impulsive trading and ensures a systematic approach. Traders should backtest their plans using historical data before live trading. Regularly reviewing and updating the plan improves adaptability to changing market conditions. Sticking to the plan prevents unnecessary risks. A well-structured trading plan increases consistency and confidence. Every trade should be executed based on the predefined plan. Proper documentation of trading activities aids in refining strategies over time. 9. Understanding market volatility and risk events. Market volatility can lead to sudden price swings, increasing trading risks. Traders should monitor economic calendars for major news events like interest rate decisions, GDP reports, and employment data. Avoiding trades during high-impact news releases minimizes exposure to unpredictable market movements. Using wider stop-loss levels during volatile periods helps prevent premature trade closures. Adapting position sizes based on volatility ensures better risk control. Understanding how different currency pairs react to news events improves decision-making. Analyzing historical volatility trends aids in preparing for future market fluctuations. 10. Regular performance review and adjustments. Consistently reviewing past trades helps traders identify strengths and weaknesses. Analyzing trading history reveals patterns that need improvement. Performance metrics like win rate, average risk-reward ratio, and drawdown levels should be monitored. Adjusting strategies based on performance analysis enhances long-term success. Keeping a detailed trading journal provides valuable insights. Learning from mistakes prevents repeating costly errors. Continuous improvement in risk management strategies leads to sustainable profitability. Traders should stay updated with market developments and adapt accordingly. Effective risk management is the foundation of successful Forex trading. By setting stop-loss and take-profit orders, maintaining a proper risk-reward ratio, and controlling leverage, traders can protect their capital and minimize losses. A disciplined approach to emotional management, diversification, and regular performance review further strengthens trading success. No strategy eliminates risk entirely, but implementing these techniques ensures a sustainable and profitable trading journey. Mastering risk management is the key to long-term success in Forex trading.